Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to use. The war in Iran has rattled the markets, with the price of oil pushing the stock indices lower and higher. But are the indices reflective of what is happening in the overall market? And how should you view what is happening for the long term? We'll have some opinions coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial experts and advisors, and they are Kerry Coghill of Coghill Investment Strategies. Next, we find Frank Rossetti. Frank has his own alternative investment company, HF Management Company. Also sitting with us is Kim Forrest of Boca Capital Partners. And one more spot at the table is occupied by Michael Godwin, the Chief Investment Officer for Fergasso Financial Advisors. Thanks so much for joining us once again for The Bull, the Bear, and You. And it's been an interesting 2 weeks since the last time we met. And as a matter of fact, the war against Iran erupted, and that eruption caused a major drop in the stock markets, and especially the indices. As of the close on Friday, March the 20th, three major indices were down roughly 4.5% from 2 weeks ago. And from their most recent all-time highs, the Dow and the NASDAQ were less than a percentage point away from what they call correction territory. Now, on Monday, though, the markets rallied, regaining some of what they lost, but all of the indices are down for the year. Those are the stock indices, and that leads me to my first question. Are those losses in the indices reflective of the wider market? In other words, were most stocks hit as hard as the indices?
Yeah, year to date, to your point, Stacy, the markets are down about a little over 4% this year. More than half of the sectors in the S&P 500 are positive on the year. All right, the tech's down, which is tech's going to be the biggest sector in the S&P 500. That's going to drive most of the markets down quite a bit. But energy, to Frank's point, energy is up 37% year to date. Consumer staples up 6.5%. Your defensive proxies, utilities up 6%. So a number of different sectors are actually up on the year. But when you are heavily weighted to tech, you're heavily weighted to, financials having a pretty bad year. Consumer discretionary stocks, obviously, with oil prices going up, they're going to get hit a bit too. So there is a dichotomy in performance regarding more of the defensive proxies, those stocks less influenced by or negatively influenced by oil, which are going to be driven down. And then the energy names and your defensives, rallying quite a bit. So there is a bit of a push and a pull there.
Yeah, it's, we usually do see this, right? Like when you're looking at particularly the S&P 500, which is a market weighted index, those larger cap companies, and this highly representative of technology, are really going to sway the index. And I'll tell you, in working with clients, it's a big challenge as an advisor because it takes educating clients about the different sectors of the market and about different approaches. So for example, let's say that we're investing in, whether it's stocks or mutual funds within these sectors, we focus on growth and value. And inevitably, clients want to chase performance, right? Like right now, we're getting all kinds of calls and emails about like, should I be buying energy? Well, it's kind of too late, right? Like that's why if you have an all-weather portfolio, you should be capturing your gains along the way and rebalancing those into areas of the market that have not done well. That is counterintuitive to emotion. So when the Mag 7 was performing and going off the charts, instead of buying more, rebalancing, which is what people wanted to do, they should have been taking their gains and putting it into some of these other sectors. That's the whole idea behind portfolio optimization and asset allocation, because you can't time the market. So creating an all-weather portfolio that can sustain various, crisis is really important in order to achieve stability particularly for our clients who are looking to achieve certain goals like having retirement income and not outliving their money.
So let's talk about technology. I think Carrie laid out what everybody's goal should be. It is not chasing return. It is not trying to get into the new thing. It is, how is my money going to work for me? But I do think, and actually everybody has laid this out masterfully so far, but I'm just going to double down on it, that technology now is a huge part of just about every index. And indexes are what we use in this business to see, are we doing better? Are we doing worse than we should be, right? So not only do we have a war on, but we have a war within AI. It is crazy out there in tech land, and it is showing up in your portfolio. This is I look at individual stocks, and because I was a software engineer, I really pay attention to technology. And those stocks have been acting really crazy, like, oops, AI isn't a thing. People sell out of it. Oops, AI is a thing. Let's all buy back in. And I think you really have to be disciplined, have a long-term view to be able to get through any kind of roller coaster market. But this one's especially complicated because we have geopolitical events happening at the same time. We're trying to make some decisions on technology, and then there's the economy, which we haven't gotten into yet, but that is also a huge driver of this. So if you're at home watching this feeling whipsawed, you should. This is what's happening in the market.
As the elder statesman here, let me say that it's critical that you get off the ledge, kind of tune out what's going on, and remember what your long-term objectives are. If you're trading for next week, you're just going to beat yourself up because next week is totally unpredictable. Every other part of a day, the opposite is being said by many people. No one knows what the truth is. What we know is eventually this war will end. Eventually the oil infrastructure will get rebuilt. And eventually electricity will be more dominant than oil. And it's like having a jigsaw, one of those geometric jigsaw puzzles. When you look at it, you say, how do you ever put it together? Right now we have all these pieces, and it's changing. It's the economy. We're going through a mass change in economy due to AI. Just like we did with the Industrial Revolution, we're doing it again. And I've never been a big proponent of indexes, but I am now because there is no way to know who's going to live and who's going to die from these companies. There's hundreds of them. Kim, you may have a clue. I have no clue who's going to survive. The winner today may be non-existent 10 years from now. There's just no way to know this. Indexes, market-weighted indexes, will take care of that for you because as the winners ascend and the losers decline, the index will adjust and it'll naturally move you into those winners. And if you're in an index fund of some sort, whether it be an ETF or a fund itself, it self-corrects as the evolution of this happens because it's unpredictable.
Okay, well, this raises a lot of different questions for me. The first of which, if this is a roller coaster, and Carrie, as you said, you want to start to rebalance once you've had some gains in this. Let's just say you have oil stocks right now. Are you trying to get off that roller coaster at the height and then hope that you don't fall down onto the ground, or are you waiting for that roller coaster to come down and let you off? I mean, how do you decide when a great time is to exit those stocks?
Oh, it's such a great question because you're making the assumption I know where the top is and I know where the bottom is, and I don't. So knowing that is the baseline, right? We have to accept the fact that we don't know the answer to where is the peak and where's the bottom. So what we have to rely on is risk, is that when any position has a bigger percentage or bigger allocation in a portfolio, that portfolio is more susceptible to swings in that particular stock, that particular sector. So what we know for our clients is we know what their risk tolerance is. So when we look at portfolios and we look at how different things have grown, what added risk do we have? And is that risk from the sense of volatility? And is that added volatility something that the client can live with? In some cases, if we feel that we're in a sustained environment, oil's tricky, right? Because one sentence and it can reverse, the end of this crisis and it can reverse. So I'm a lot more inclined to be taking gains during periods like this because it can change on a dime. When it comes to technology stocks, it's a little bit different because we know that some of these companies, particularly ones that have been very volatile, we know that they're here for the long run. Some of these companies have inherent ecosystems built around them. And so when those types of companies, those secure ones that we know are going to be around, when they go through a period of incline, the two questions we ask ourselves is, can the client live with the added risk? And if we do rebalance, what are the tax consequences? And that's really where the collaboration with the client comes in to say, hey, listen, this is why we feel we need to rebalance, or this is why we're not rebalancing. How do you feel about that? Volatility scares people. And it's really important as advisors that we're in touch with the risk tolerance with our clients. They also don't like paying taxes. So it puts us in a tricky position, right? Like with the advisors here at our firm, in managing the money, I might want to rebalance a position and they're like, no, the client doesn't want to pay taxes. And I'm like, well, why don't you explain the risks to the client and the tax consequences and see how they feel about it?
So, Michael, I have to ask you, from Kim and Frank, it seems like AI is going to be more important right now than the oil situation with whatever companies it might affect. As the chief investment officer for Fergaso, how are you viewing this right now?
AI or oil?
Which one do you think is overriding, or are you looking more long term and just letting the oil situation play out, and then in AI? Because I can also argue that what happens with oil could have a long term impact on the economy itself, being that these prices don't come down.
Right. Going back to Frank's point on this war will end, oil will correct itself at some point. Again, we can get into the natural gas situation in Europe, but we don't need to get into that. That's going to be that's a longer term play more so than the oil markets reversing. It's whenever the war ends. But I've always said this: you cannot make investment decisions based on geopolitical moves, right? If you think what's going to happen in the war, when Washington has absolutely no idea when this is going to end, you're kidding yourself. You're making a trade, you're making a bet, you're making a gamble. You're not making an investment decision. So we've done virtually nothing in our investment portfolios due to the war going on in Iran. To Carrie's point, it's time to make maybe rebalancing decisions because certain segments of the markets have moved quite a bit. So you trim back to target, or you add and get to target. But we don't make model decisions or allocation changes based on what's going on in Iran because you have no idea when it's going to end. Washington doesn't know, etc. AI is a different story here because that can have impacts on the global economy. You can make investment decisions based on what your perceived outcome might be based on AI. Will this company adopt it more? Will margins expand more in this sector because they're utilizing AI more so than their competitors, etc. So AI is we still think it has a long runway in the economy and the markets, and you can make adjustments to it there as well. But again, there are a number of different ways to play it. You can go long, as Kim has talked about before, the chip companies, the Mag 7 companies who are building out all the infrastructure, or you can go and take advantage of some of the companies like maybe McDonald's, who's using it quite a bit more in their day-to-day processes. So there's a lot of different ways to play AI, which I think as an investor you can do the nitty-gritty work to figure out what you want to do there. When it comes to a geopolitical event like this, you're kidding yourselves if you think you know more than either one, what the market is already priced in, which Kerry mentioned, like the energy stocks or the defense stocks, or two, you know when the war is going to end, when no country on earth knows when this is going to really end.
There's another little aspect to this. I just realized that when you're talking about energy stocks and AI, they do go hand in hand in a way, because the amount of power, energy that the AI data centers are going to need. So I would say that you don't abandon oil or energy. Am I correct on that?
I agree. There is, without energy, those processors aren't going to just figure out things themselves, right? I'm supposed to be funny. Maybe that's not funny. Anyhow, I also have to say this about the geopolitical situation. Everybody likes to look to the past and say, aha, I know what's going to happen. And for energy in particular, people look to the 70s when we had energy crisis, right? We had 3 different energy crises. But in pretty much all situations, nothing overlaps 100%, that it's the same. The United States is now a net exporter of energy, and we were a pretty big net importer of energy in the 1970s. And so I would not look to the 1970s as a way to reposition your portfolio. I'd just like to throw that out there into the mix.
Yeah, I agree with that completely, especially like we are a very different economy. So, that has impact too. And you have to look at like these data centers. It's a huge drain on energy, but the amount of renewable energies that are supporting these data centers too help to offset the challenges that we have with energy. And I would imagine as they're continuing to be built, that will be the case, that there will be a lot more renewables factored in.
I'm going to throw this question out, and Frank, I'll pose it to you as the sage of the panel here, and that is, Kerry, and I believe everyone has mentioned so far, the volatility in the market. It didn't used to be this way, and is there a different approach than that you've had to take, or as investors have to take, because the volatility has increased so much over the years?
I don't think the volatility is any more than it was. On a percentage
Really?
basis, it's very similar. In points, it looks like it's a lot more.
Okay.
But when I started my career, the Dow was measured in hundreds. Now
Right.
it's measured in tens of thousands. All right, so if you had a 500-point move now, that's like a 50-point move, or maybe a 5-point move when I started. I mean, so it looks volatile, but it's not.
And
Right?
actually,
We have this big volatility. It's only pulled back 5% before yesterday. That's not a big deal.
yeah, and it's
But the numbers look big, as you point out.
Yeah, it's the big numbers, but it's not big percentages. And so you need to put all that in perspective. And the reason is it's all relative. I mean,
yeah, I think we've actually
it's
just.
not any more volatile than it's ever been. Maybe less so, actually.
Yeah. I would agree with that. I think that we're coming through a period, maybe, I don't even know how long, the last year, 18 months, where it has been kind of concerningly lower, has had concerningly lower volatility. So yeah, I agree, Frank. And you do have to look at percentages, because the points kind of scare you.
Part of the reason for that is these big companies that, we just talked about how they're kind of driving the market down a little bit, the tech's leading the market down a little lower, but the past few years, these big companies that make up the preponderance of the S&P 500, the Googles, Apples, etc., they are very solid companies. They generate a lot of revenue growth. They generate a lot of earnings. They have very little earnings variability. So their earnings are pretty steady going up. And when you have that, generally speaking, they're going to have a little bit less volatility in the markets. Now, we're in a period today where obviously the volatility is higher than the average over the past 10 years or so, given the geopolitical environments that we're in. But, going back 1 month, we're at very, very normal periods of volatility over the past, recent history.
I have to tell you, I'm so happy about this conversation. We're talking about elements of mathematical modeling and what goes into the model of the economy. Go us. This is one of my favorite conversations ever.
Well, let's get out of the weeds.
Well, Kim, you mentioned it a little bit ago that we hadn't gotten into talking much about the economy. And its last meeting, the Fed chose to stand pat on interest rates. Now there is talk of heightened inflation because the price of oil has an impact on so much of the economy. In fact, the speculation was that the Fed would be cutting interest rates maybe a couple of times this year. Now it's turned the Fed may be raising interest rates. And one Fed governor basically said at this point, it is anyone's guess. So will this quandary of where interest rates might be going have an effect on anyone's portfolio?
Oh, wait, you forgot one overriding fact that Kevin Warsh, the incoming Fed chairman, has to be approved too. So I think this is the theme for 2026. But wait, there's more. Because every time we explore a concept, we're like, oh, there's another layer to this. And I think the moving layers are almost impossible to be able to forecast what the Fed is going to do. And I've thrown my hands up because I think they're most concerned about employment at this point, not necessarily prices, but it feels like, given, as what you said, the oil concerns that's the base of the pyramid, of the economic pyramid. Anyhow, that it's a concern. So, and then with the changing composition of the leadership, I don't know, that Kevin Warsh feels like he is inclined to lower rates. So I'm not trying to forecast it anymore. I have to kick this over to somebody else.
Let me stick with what I said 2 weeks ago. The Fed's going to do nothing. And the reason is first of all, the Fed is in disarray. They're being sued. We've got a change in leadership, maybe. And right now we've got conflicting things. We've got employment that's not as strong as they'd like it. And we've got all these outside things creating inflation that raising interest rates won't stop. So their position logically has to be do nothing until something actually happens, like employment either actually gets weak, the economy actually slows down, which hasn't really happened. There's signs that it's happening, but it's not happening, or the inflation becomes demand pull or cost. Right now it's event push inflation, not cost push or demand pull. So interest rates really have nothing to do with these events. So that's not going to fix the inflation problem. So my position is logically they should do nothing because they're not high.
You made a critical error there, Frank. You
Of
said
course. Only one.
Yeah, you said using logic. That may not be appropriate.
So,
Carrie, you were going to say something.
yeah. So I still stand by what I said on our last episode that if it were me, I would lower interest rates. I feel that the inflation that we're having, where's it coming from? Primarily energy. We do have some ancillary inflation in the system, but I feel that the economy is definitely, I shouldn't say definitely, I can't say that. I feel the economy is weakening. I feel that we've seen that in recent numbers. I feel that given higher energy prices, we'll continue to see that. And when you go back to times where this has happened similarly in the past, 2008, in the early 90s, we did have a Federal Reserve that lowered interest rates. To answer your question about how this is impacting portfolios, it is absolutely impacting portfolios that are diversified. Our baseline foundation for allocating money for clients is asset allocation, mainly between stocks and bonds. And because of this shock, the oil shock, and the perceived inflation and the perceived cost of the war, we have been seeing interest rates go up. When you own bonds and interest rates go up, the value of your bond goes down. So what clients have been experiencing during this conflict is both their stock portfolio and their bond portfolio are temporarily moving in the same direction, and that's been down. So, as a advisor, what we have to watch is, what are our durations on these bonds? Are we long-term? Are we short-term? What's our credit risk with an economy that's slowing? So managing, no one likes to talk about bonds and managing bonds because it seems kind of boring, but it's actually not.
I mean, that's such a good point on Carrie's. She's 100% right on all that stuff. And this will be the one area where Carrie and I, not one of the area, but we differ on how we do this, because we at Fragasso, we do not a lot. We do some in the alternative investments, the semi-private investments here. And one of the rationales was because of this instance today, where you're starting to see stocks and bonds become more correlated in certain environments, like today. Like 2022 is probably the best example you can give by far. And so we try to pivot a little bit to looking for unique asset classes where one really zigs and the other one, it doesn't really matter what's going on in the market, because it's tied to infrastructure related assets, which are long, slow moving, long-lived assets with long-lived also contracts in place with various companies or municipalities and whatnot. So it's important, I think, to Carrie's point, there are certain bonds on the public side that are probably doing pretty well. Short duration bonds are probably actually up, whereas if you own the long duration bonds, you're probably getting hit as well. So it is important to make sure your portfolio is diversified in a time like this, because if it's not, you could be in the unfortunate situation where you think you're in a balanced portfolio, 60% stocks, 40% bonds, and unfortunately they've both kind of gone down in this type of environment, and that's certainly not what you want. You want to have definitely certain securities in your portfolio that can zig when everything else might zag.
What about stepping on a step ladder kind of approach with the bonds, if I'm making any sense to you?
Yeah.
You mean a ladder?
The ladder, yeah. No, you have to step on the ladder. Anyway, go ahead.
Okay. Well, if laddered means you have maturities starting very short and ending out maybe 10 years, depending on what your time horizon is. And that is a way to reduce volatility. And in this environment, you don't even reduce income, because the spread between short and long-term rates is pretty low. But I haven't been a proponent of bonds for a long time, because interest rates are just, even now, too low to take the risk of rising interest rates. You aren't getting paid for the risk of rising interest rates. So I would prefer, like Mike was alluding to all the other forms of income generating assets. Not that they're risk free, but they have different risks.
Okay. Well, let's wrap it up for right now. We've got a lot more to talk about the next time we get together, and we'll continue our look into the economy and investing. And since you're watching or listening to this particular podcast, I ask that you hit the like or the subscribe button on whatever platform you happen to be using. But for now, thanks for joining us. We'll see you again for the next edition of The Bull, the Bear, and You.